All right, welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through the market weakness. I'm your lead analyst. Today, we are putting Snowflake, ticker SNOW, squarely under the microscope. They just dropped their Q4 numbers, and to be honest, the market's reaction has been, well, it's been confusing. So our job today is to deconstruct this thing. We're going to stress test the fundamentals and figure out once and for all if Snowflake is really building a fortress for this AI revolution or if it's all just a really, really beautiful facade. Let's get to work.
Okay, let's just jump right into the meat of it. Look at the left side of your screen. On paper, this is a picture-perfect quarter. I mean, it's a flawless victory. Revenue? They hit $1.28 billion, absolutely smashing the Wall Street estimate of $1.26 billion. Check. Adjusted earnings per share? 34 cents. The consensus was looking for 27 cents, so they didn't just beat it, they crushed it. And their guidance? Their look into the future? Strong. By every single traditional metric you can look at, this was a home run, a trifecta of wins. But hold on a second. A flawless victory? Then someone needs to explain the right side of the screen to me. The stock popped, sure, for about 5 minutes. And then boom, it sold off hard, ending the after-hours session down almost 4%. So the report is screaming win, but the actual market, the people putting real money on the line, they're screaming loss. That's the paradox, isn't it? That's what we're here to figure out. The headlines are all cheers and applause, but the price action is telling a completely different and frankly a much more worrying story. Something here just does not add up.
And that, right there, is the big question. That's what this entire analysis is about. You have to remember, the market isn't usually irrational. It might seem like it, but it's really just a machine that's processing a ton of information, especially the information that's not right there on the surface. So our job today here at Iron Financial is to dig way beneath those headline numbers. We're going to put this company through a serious stress test. Exactly. We've got to figure out if the market is just having a knee-jerk overreaction to something small, or is it sniffing out some real fundamental cracks in the armor that all the bulls are conveniently choosing to ignore. We're going to separate the signal from all the noise and tell you what actually matters for your portfolio. All right, so before we go looking for all the weaknesses, we have to understand the strength. You have to give credit where it's due. So I'm going to take the lead here. I'm going to build the bull case for you, piece by piece, using the company's own data. See, any solid investment, it has to have a solid foundation. And when you first look at Snowflake, it really does seem like they have poured some serious reinforced concrete. So let's examine the structural integrity of this growth story. First things first, it always starts with the top line, revenue. The company pulled in $1.28 billion in total revenue for Q4. Now look, that's not just a number on a page. To really get its power, you have to put it in context. Wall Street analysts, the so-called experts, they were expecting $1.26 billion. So Snowflake didn't just squeak by, they beat it decisively. And what that tells you is that even in a pretty tough economic environment, the demand for their data cloud platform isn't just holding up, it's actually accelerating. This is the first and maybe the most important pillar of the entire bull case. They say they're going to deliver, and they do. And you have to understand, this isn't some one-time fluke. The real story here is the momentum. We are looking at a 30% year-over-year growth in what they call product revenue. Now, in the big leagues of enterprise software, trying to maintain a 30% growth rate when you're already this big, I mean, we're talking about over $1 billion in a single quarter. That is incredibly, incredibly difficult to do. It shows you this is durable momentum. This is not a company that's about to hit some kind of growth wall. No, it's a company that's finding new gears. This number tells you the core engine of the business is just firing on all cylinders. So the question is, how are they doing that? How are they getting that growth? And this number, this one right here, this is the magic number, 125% net revenue retention. Let me just break down for you why this is basically the holy grail for a software as a service company. So imagine Snowflake had 100 customers last year, and those customers paid them a total of $100. Okay? Now fast forward to today, those exact same 100 customers are now paying them $125. They haven't even added a single new customer to the mix, and their business is already growing by 25%. This is powerful proof that the product is becoming more and more essential to its users over time. It's the ultimate sign of a sticky platform. It is way cheaper and more profitable than constantly trying to find new customers, and it proves that the product is delivering real, massive value. This right here, this is the bedrock of their future profitability. And hey, you don't have to just take my word for it. Look at this. This is an earnings scorecard from 24/7 Wall Street. They looked at the whole quarter and gave it an overall grade of A-. Let's break that down. Revenue performance, they get an A. No big surprise there. We just talked about the big beat. Earnings beat, another A. Again, they cleared that hurdle with plenty of room to spare. Now, the only reason this isn't a perfect A+ is because of the GAAP operating loss. That's the official by-the-books accounting number. And I am sure my skeptical colleague over here is sharpening his knives for that one as we speak. But look, from a pure operational standpoint, this scorecard is objective proof of a nearly flawless execution this quarter. All right, so if net revenue retention shows us how much customers spent in the past, this next number, RPO, that stands for Remaining Performance Obligations. That tells us what customers have already promised to spend in the future. You can literally think of it as pre-orders for their data services. It's contracted revenue. And get this, Snowflake has nearly $10 billion in signed contracts just waiting to be recognized as revenue. This isn't some pie-in-the-sky forecast. This is money that is already on the books, locked in. And having nearly $10 billion of future business already secured, that gives a company incredible visibility and stability. This is the structural steel that supports the entire bull thesis. It tells us that the growth we are seeing today is very, very likely to continue well into the future. And just to cap off the bull case, we have the strategic vision straight from the new CEO himself. Snowflake sits at the center of the enterprise AI revolution. Now, I know what you're thinking, but this isn't just some corporate buzzword bingo. Think about it. Every single company on this planet is scrambling to build an AI strategy right now. And that strategy, no matter what it is fundamentally dependent on one thing: clean, organized, accessible data. Snowflake's whole argument is that they provide that foundational layer, the data cloud, that this entire multi-trillion-dollar AI revolution is going to be built on top of. So the bull case is crystal clear. You have stellar current performance, massive forward visibility, and perfect positioning for what is arguably the biggest technological shift of our lifetime, a fortress in the making. A fortress. Wow, that's a strong word, a very strong word. And, it's my job to see if that fortress can actually hold up under a little bit of pressure, because a beautiful exterior can hide a completely crumbling foundation. So now it is time for the stress test. The market sold this stock off for a reason, and I guarantee you it wasn't because of the shiny numbers my colleague just presented. It's because of what's lurking just beneath them. So let's apply some pressure. Let's see what starts to creak.
So yeah, if the numbers are so fantastic, why the drop? Are there cracks in this so-called armor? The short answer is yes, absolutely. And we're not talking about small little hairline fractures here. These are significant issues that any serious investor needs to look at very, very closely. The market isn't dumb. It's a forward-looking machine, and right now it is pricing in risks that the bullish narrative just conveniently seems to overlook. So let's start with what is, in my opinion, the most glaring red flag of all.
211. What is this number? This is the number of open market insider sales over just the last 6 months. And okay, how many insider buys were there in that exact same period? 0. A big fat 0. Not a single one. Just let that sink in for a second. The people who run the company, the executives, the ones with the most intimate, day-to-day knowledge of the business, have been consistently and methodically selling their own shares. So I ask you, if the future is so bright, why is the entire leadership team taking their money off the table? What do they know that we don't? This is a massive vote of no confidence from the very people who should be the most confident of anyone. Okay, now let's talk about that headline earnings beat. That was a non-GAAP number, and you need to understand non-GAAP is the company's curated version of reality. It's like taking a selfie with a very flattering filter on it. The GAAP number, on the other hand, that's the unfiltered, harsh light of day reality. And the biggest filter they use here is stock-based compensation. See, Snowflake paid its employees over $423 million in stock. That is a very real expense. But in their non-GAAP number, they essentially get to say, hey, let's just pretend that didn't happen. And when you take that filter off their $118 million profit, it doesn't just shrink, it completely evaporates and becomes a staggering $309 million loss. This company isn't making money, it's losing it at an absolutely incredible rate. But maybe, you might be thinking, maybe this quarter's drop was just a one-off thing. Wrong. This is a pattern. Look at this data from Market Chameleon. They analyzed the last 12 quarters, and historically, the stock runs up into the earnings announcement by an average of about 1.7%. Hopeful traders, they bid it up, right? But what happens after the news actually comes out? An average drop of 0.5%. So this quarter's big drop wasn't some kind of anomaly. It was an amplification of a recurring problem. The market has been trained over and over again to buy the rumor and sell the news on Snowflake because time after time, the underlying reality just fails to support all the pre-earnings hype. And the cracks just keep showing up when you look at the balance sheet, which is the true measure of a company's financial health. I mean, even the bull's own A- report card had to knock off points for this. Cash and cash equivalents are down over 7.5% from a year ago. A healthy, growing company should be piling up cash, not burning through it. And at the exact same time, their total liabilities are up almost 20%. So let's just be perfectly clear about what's happening here. They have less cash on hand and more debt and obligations on the books. This is a weakening financial position, plain and simple. And that puts pressure on the business and it reduces its flexibility to invest and to navigate any future challenges. Okay, those are all valid points. The gap loss is significant, I'm not going to deny that, and the insider selling is definitely a concern. But you're focused entirely on the past. The whole bull case, the reason the stock has the valuation it does, is all predicated on the future. And the future is AI. So this is the ultimate stress test right here. Is the AI strategy a genuine load-bearing pillar that's going to support all the future growth and profitability, or is it just a bunch of hype designed to paper over the very cracks you just pointed out? Well, the evidence strongly suggests this is far more than just a buzzword. First, just look at their execution. The launch of their Snowflake intelligence platform was one of the fastest and most widely adopted product launches in the company's entire history. So customers are not just kicking the tires on this thing, they are actively deploying it. Second, look at the partnerships. I mean, come on. They've signed massive, multi-year, $200 million agreements with both OpenAI and Anthropic, the two undisputed leaders in large language models. This isn't just a press release. This is a huge financial commitment to integrate the best-in-class AI directly into their platform. They are building the essential toolkit for enterprise AI, and the adoption and investment trends show it is a very real, very tangible part of the business. But that is the multi-billion-dollar question, isn't it? Look, I'm not denying the AI narrative is compelling. It sounds great. What I'm questioning is the timing and, more importantly, the economics. Can the promise of future AI revenue realistically offset the current reality of a $310 million quarterly gap loss and a flood of insider selling? It's a race against time. The company is burning through cash right now, and they are hoping that AI monetization will ramp up fast enough to fill that massive profitability gap before the market completely loses patience or the balance sheet gets even weaker. The AI story needs to translate from a nice narrative into cold, hard gap profits, and it needs to do it soon, because right now, it feels a lot more like hype than a reliable revenue driver. All right, we've laid out both sides of the argument. You've seen the solid operational foundation, and you've seen the worrying structural cracks. So now it's time to bring it all together and deliver the final verdict. Is this post-earnings dip a buying opportunity, a chance to get into a long-term winner at a nice discount? Or is it a trap, a warning sign of much deeper issues that could lead to a lot more pain ahead? So let's just quickly rebuild the bull's fortress, brick by solid brick. First, you have that durable 30% growth at scale, with consistent solid beats on both the top and bottom lines. Second, you have incredible forward visibility with that 42% growth in RPO, which means a ton of future revenue is already locked in. Third, the customer momentum is just undeniable, with a 125% net revenue retention rate that shows a super sticky and expanding customer base. And finally, you have what is arguably the pole position in the entire enterprise AI race. This is the case for a best-in-class company building a durable, long-lasting fortress. But our stress test revealed the very real cracks in that fortress. First, and I think this is the most important, you have the undeniable red flag of 211 insider sales with absolutely zero buys. Second, the complete and total lack of real GAAP profitability, which is being masked by those non-GAAP adjustments. That $310 million quarterly loss is real money. Third, there's a historical pattern of the stock selling off after earnings, which suggests a chronic disconnect between the hype and the reality. And finally, you have a weakening balance sheet with declining cash and rising liabilities. These are not minor issues. These are significant cracks in the foundation. And so that leaves us with the ultimate question for you, the investor. Do you believe that the operational strength and the AI positioning are powerful enough to overcome the serious profitability issues and the obvious insider skepticism? Or do you believe the negative market reaction and all those underlying financial cracks are a clear warning that this beautiful growth story is just that, a story, a facade? The data is on the table. The decision is yours. Thanks for tuning in to Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.